I've taken a little bit of a hiatus from REITs since making my video a few months back about investing in REITs within a Roth IRA, which, by the way, if you're not doing yet, definitely check that out. But at that time, I threw a couple REIT index funds from Vanguard into my portfolio and called it a day. I've grown a lot as an investor since then, and with some of this new knowledge, I thought it was time I revisit REITs and make sure I've got the best of the best in my portfolio. But as usual, I'd rather do this with REIT funds than taking on the risk of individual stocks, especially for a long-term portfolio like my Roth IRA. So today, I'm taking a look at some of the best options out there in order to find a fund that will track the returns of the overall real estate market while also offering some hefty dividends. I'll walk you through my criteria for screening through various funds, and then we'll take a deep dive into some of our options to see which ones make the final cut. So if you're ready to collect some sweet real estate dividends, let's jump into it. Just to give you guys a heads up, I'm going to be looking at both ETFs and closed-end funds today. ETFs are a little more common and straightforward, but I recently learned that closed-end funds can offer higher returns and higher yields, often at discounted prices. I think this can be particularly powerful for REITs, so this is why I'm including closed-end funds in my search as well. If you want to learn more about how closed-end funds compare to ETFs and open-end funds, I just put out a video on that a few weeks ago, and it'll tell you everything you need to know to understand my process for looking at REIT funds in this video. Luckily, we don't have too much to sift through with just 44 REIT ETFs and only 8 REIT closed-end funds. In order to research these both properly, I'm going to use two separate websites, etfdb.com for the ETFs and cefconnect.com for the closed-end funds. So we're going to start with the ETFs and then take a look at the closed-end funds afterwards. If you guys have seen some of my previous ETF videos, you'll be pretty familiar with my screening process. Using the screening tool at etfdb.com, we're already starting at just 44 REIT ETFs, but I'm going to add a few more filters to narrow down our list further. First, one of the main reasons I'm so interested in REITs as an investment is because they pay higher dividends than other stocks. Obviously, a lesser correlation to the stock market is a big benefit, but I really want to make sure my investments take full advantage of the high yields that REITs offer. All this is to say, I'm going to screen these REIT ETFs for funds that pay at least a 5% dividend yield. Next, as most ETFs are passively managed, I think that an ETF with a solid methodology for selecting its holdings will generally perform positively over long-term periods. This is because real estate is an asset that gradually goes up over time. So if an index can't replicate that same pattern, it's probably doing something wrong. So I'm also going to screen these ETFs for funds that have achieved a positive return in the last 5 years. I know COVID hit a lot of REITs pretty hard, so I'm expecting this will weed out some of the bad ETFs, but still show us the ones that have done well over the longer time frames. And with these two screening metrics alone, we're down from 44 to just 6 REIT ETFs that meet our criteria, so that makes things pretty easy. I'm greedy for dividends, so the first thing I always look at this point is dividend yield. And you'll notice that 2 of the remaining 6 ETFs are in the double digits. But it's important to note that these ETFs are actually focused on mortgage REITs, which is very different from traditional REITs. Instead of investing in real estate themselves, mortgage REITs invest in the mortgages that people use to buy real estate. So they're lending money, providing financing services, and actually earning income through interest instead of collecting rent on properties. This is great for income, as you can see by the dividend yield, but you don't get the benefit of investing in the actual properties, which is one of the most important characteristics of REIT investments. These investments are also heavily affected by rising interest rates, which we can expect to see in the short term after the economy recovers from the COVID pandemic. Furthermore, data from the National Association of Real Estate Investment Trusts shows that mortgage REITs have dramatically underperformed traditional equity REITs over just about every time frame. So these ETFs are clearly not going to cut it. And when you compare the remaining 4 ETFs, there's a very clear winner, and that's VNQI, the Vanguard Global ex-US Real Estate Index Fund ETF. First of all, it has significantly more holdings than the other options, making it way better diversified. Next, it has the lowest expense ratio of any of the ETFs, making it the most cost-efficient to invest in. It's also produced better returns than any of the other ETFs, which gives me confidence in its methodology. And lastly, its dividend yield is about 7.5%, which is comparable to the remaining options. With these obviously superior stats, I feel good selecting VNQI as my top ETF choice without digging much deeper into it. The only problem is this ETF completely excludes US-based REITs, and I definitely want my REIT investments to be more weighted into US stocks, so I need something to balance this out. Luckily, I think we'll find a good option with closed-end funds. Switching over to cefconnect.com, like I mentioned earlier, we have just 8 options to explore. Fortunately, all 8 of these options meet my previous criteria of having a minimum 5% yield and a positive return over the last 5 years, although some of these are definitely on the lower end. And one of my first concerns with closed-end funds is that they're actively managed. Unlike the Vanguard ETF that follows a methodology that's clearly effective, these funds all come with the risk of active management. Because of this, we're more likely to see things like high portfolio turnover, or worse, a portfolio that can't keep up with the returns of the market. So the first thing I want to do with these 8 funds is take a deeper look at their returns since inception. Since most of these funds will still have the same team managing them as they started with, taking a look at the overall returns could give us some insight into the funds that have been and will continue to be the most successful. And again, if these funds aren't able to somewhat track the trends of the overall real estate market, I'm not interested. So first, PGZ, Principal Real Estate Income Fund, looks tempting at a 13% yield. But it's been around since 2013, and ignoring the recent COVID crash, it's accomplished no capital appreciation in the last 7 years. So this one is out. Next is NRO, the Neuberger Real Estate Securities Income Fund, which has definitely seen better days, but at least it's had an uptrend for the last 10 years, so we'll revisit this one in a minute. Next is IGR, the CBRE Clarion Global Real Estate Income Fund, which has struggled to go anywhere for the last 10 years, so I'm ruling this one out too. Next is JRS, the Nuveen Real Estate Income Fund, which again, generally flat for the last decade, so I'm crossing it off. Next is AWP, the Aberdeen Global Premier Properties Fund. More of the same with uneventful price growth for the last 10 years. It's out too. Next is RFI, the Cohen & Steers Total Return Fund, which looks like it's had some good runs in the past, but with inconsistent performance, I'm going to pass on this one. Next is RQI, the Cohen & Steers Quality Income Realty Fund, which has posted fairly impressive returns and fairly regularly for the last 10 years. This one's making it through to the next round. Last is RNP, the Cohen & Steers REIT and Preferred Income Fund, which also has pretty nice returns for the last 10 years, and looks pretty similar to RQI. So we're down to NRO, RQI, and RNP. And one of the next things I look for immediately in a closed-end fund is the distribution history, primarily because a lot of funds will offer a really high yield on the surface, but they'll actually be funding these distributions with a return of capital, which is money that technically comes from your initial investment and not the earnings of the fund. I go into why this is a problem in my video on closed-end funds, but I'll quickly summarize it here. A distribution with a return of capital reduces your cost basis, meaning you'll end up paying a higher capital gains tax whenever you sell your shares. And worse, a return of capital could suggest that the fund isn't earning enough money to pay you distributions. To continue providing their advertised yield, they'll sell some of their holdings and return some of your original investment to you, which over time will drain the NAV and thereby the value of your investment. So I do not want to see these in a fund's distributions. Taking a look at NRO's distribution history, they've been nothing short of consistent with monthly distributions of 4 cents, which equates roughly to a 12% annual yield. But 75% of every one of these distributions has been a return of capital, which is far more than I want to see. For this reason, I'm not interested in looking into this fund any further, and that leaves us with just 2 more options. So taking a closer look, RQI and RNP are looking pretty similar. Both from Cohen & Steers, both about a 2% expense ratio, both using leverage of around 25%, both with very similar historical price performance, and only a slight difference in yield between the two. RQI yields around 9% on price, and RNP yields around 8% on price. The key difference here, though, is the portfolios. RQI is the Quality Income Realty Fund, which aims to invest its entire portfolio in REIT stocks, with about 20% being allocated to foreign stocks. RNP is the REIT and Preferred Income Fund, which means it's holding a portfolio of both REIT stocks and preferred stocks from other sectors. Its top holdings are actually the same as the top holdings of RQI, and it's weighted heaviest into REIT stocks. However, it looks like a majority of its non-REIT holdings are in the finance industry. And considering all of the damage that COVID did to big banks, you may want to consider this before investing. Now, I think the added element of non-REIT stocks could be cool for diversification. But since I'm looking to fill a certain percentage of my portfolio with REIT investments, I want all of it to be invested in REITs, not diluted elsewhere. That said, RNP is not going to make the cut for me. But if you're not yet decided between the two, I'll link an article I found on Seeking Alpha that compares these two funds. It has some really great insight into their short-term performance and what a future could look like throughout and after COVID, so I'd highly recommend checking it out. But after exploring our options, we're left with just one ETF and one closed-end fund. This is the Vanguard Global X US Real Estate Index Fund ETF, ticker VNQI, and the Cohen & Steers Quality Income Realty Fund, ticker RQI. VNQI has a very reasonable expense ratio of 0.12%, and a yield around 7.5% paid quarterly. And it's hugely diversified with around 650 holdings. The only catch here is that it doesn't invest in any US stocks. So I think by combining this with RQI, which has a higher 2% expense ratio, a 9% yield on price paid monthly, and 150 holdings, we'll be able to get some great diversification throughout REITs, as well as some very nice dividend distributions. A lot of experts agree that international diversification is important to a stock portfolio, but exactly how much is still a highly debated topic. I read several articles that suggested between 15 and 30%, while some argued for as much as nearly 50%. Of course, some financial experts like Warren Buffett and John Bogle suggest you'll be fine with 100% invested in US stocks. So this is clearly a topic I need to do more research on, and I will definitely make a video on it to share my findings with you all when I do. In the meantime though, I'm going to hold about 25% of my REIT allocation in VNQI for that international exposure, with the remaining 75% in RQI. I may even bump up VNQI in the future because its drastically lower costs are very appealing, but I'll save that decision until I know for sure how much of my portfolio I want to allocate internationally. With these two funds combined, I'd be getting approximately an 8.5% yield and a total expense ratio of 1.5%, so I'm pretty happy with that. Well, that should about do it for REIT funds. Leave me a comment below and let me know how you're feeling about the funds we looked at today. And if you found this video helpful, please make sure you subscribe to the channel because I've got lots more investment videos coming your way. Happy investing, and I'll see you next time.